Accounting, past and present. This first chapter really is just a lot of information that kind of is a bit of a refresher for you as you're going into using the information provided from a managerial type of concept. We go through a lot of review, a lot of things you learned in prior classes, and just reaffirm some of that information and build on it here and there. So by and large, this particular chapter is going to have you studying definitions of accounting, who the users are, why they find the information useful, some of the different things that accountants actually provide professionally. We're going to look at some of the big history that came about from accounting, talk about the FASB or FASB, generally how financial reporting standards evolved, some of the key elements of ethics. You're going to get a lot of ethics throughout this course and all your other courses, of course. Some of the reasons that FASB has their conceptual framework project, understand the general purpose financial reporting, and just look at the format of the book. So just as a reminder, accounting is the process of identifying, measuring, and communicating economic information about an entity for decisions and informed judgments. So one of the key words in here is entity. It's really important that you know that in accounting we use a lot of jargon. Entity can refer to a nonprofit organization, a corporation, a sole proprietorship, any of the variety of ways of doing business in the United States. The informed judgments. We talk about for the decisions and informed judgments. Those people that make judgments or make decisions in regards to an entity can be internal or they can be external. Either one. We will use both perspectives, and you will see how both need to know that information about your organization or your entity. Some of the users and the uses of accounting information. The internal users of accounting information include management and owners of an organization. Owners being investors or shareholders. The accounting information is used to identify and measure costs and benefits, to plan and control activities of an entity, and to support management's decision-making process. So from a management perspective, let's just take a second here and look at that. So we're looking at the planning, directing, and controlling. This goes right back to your ACC 122 class, where we spent a lot of time talking about managerial accounting. From an investor shareholder point of view, this is them assessing amounts, timing, the uncertainty of future cash returns on their investments, how their funds, how their investments are being used to generate additional benefits. External users of accounting information include the investors and shareholders, creditors and suppliers, employees and governmental agencies, and those can include the Securities and Exchange Commission, and of course our favorite, the Internal Revenue Service. Investors and shareholders use accounting information to make investment decisions about the company's stock. Do I buy? Do I sell? Do I hold? Creditors and suppliers use accounting information to assess the ability of the company to pay their debts. Do we issue them a new debt? Do we call in our debt? Are they in compliance with the covenants of the debt? There is a bunch of different answers that creditors and suppliers are looking for when they utilize this information. Employees may use the accounting information for their retirement planning, to determine the ability of the company to meet those obligations. They may also look at it as for things such as future job prospects. As you are entering into a career field, you may come upon a company that you might want to apply with, and you might want to look at how they are doing financially and the things that they do to determine if they are a good match for you. And then, of course, last but never least, and probably most important, is the Securities and Exchange Commission, who use accounting information to evaluate the company's compliance with the rules and regulations of the SEC and to ensure that the company has fully disclosed all the required information to its investors and provided the necessary notes and supplements to the basic financial statements. You'll recall that primarily in ACC 121, we covered financial accounting. This is generally the process that results in the preparation and the reporting of the financial statements for a specific entity. It focuses on the financial statements preparation for external users. As a reminder, those are created with the audience of investors and creditors in mind. Financial accounting provides a lot of historical data about an entity's business transactions. Remember, it's backwards looking. And the effects of those transactions on the current financial position of the organization, the results of its operations for a period, and its cash flows for a specific time. Financial accounting, being externally oriented, really can only look at the historical results of performance. These are things that are definitively measurable as of a given point in time. ACC 122, or Managerial Accounting, Cost Accounting. This is an accounting that is focused on the management process of planning, organizing, and controlling the entity's activities to accomplish the entity's goals. Cost accounting, however, really looks at the processes that are used by management to determine and allocate costs based upon current and, of course, relevant information. You will be utilizing and looking at both different types of accounting throughout this course, as well as financial accounting. One of the services the accountants provide is auditing. And when you hear auditing, everybody does think about public auditing. Work done by public accounting firms can vary depending upon the size and the classification of the firm. So small, little local firms typically are going to provide bookkeeping, accounting, tax prep, financial services to individuals and small businesses. The larger, the top firms, those are more regional. They concentrate more heavily on auditing services, corporate tax returns, and management advisory services. Larger domestic and international firms will provide auditing, corporate tax returns, and management advisory services, but their clients are large domestic and international corporations. The only individuals that can provide an independent auditor's report in compliance with Sarbanes-Oxley and the SEC is a certified public accountant. You will find that there is an auditor's report and an auditor's opinion in every annual report that is provided by a corporation. This report usually contains 4 brief paragraphs, and it's going to state whether the financial statements are prepared in conformity with the generally accepted accounting principles. Just as a reminder, that is often referred to as GAAP, G-A-A-P. And that report can provide either an unqualified opinion, which is deemed clean, or a qualified opinion. The breadth and scope of what those entail is beyond this particular course. However, keep in mind that a clean opinion does not necessarily mean that there has been no financial shenanigans that have occurred. What people don't often think about when it comes to auditing is that there are, for many of the very large organizations, internal audit departments. These are professional accountants who are performing functions similar to those of the external auditor. However, they are employed in that industry and not in public accounting. The internal auditor is basically responsible for reviewing financial statements and the transactions of an individual company, or really looking at the operating efficiency of the entity's activities. There is a certification attached to auditing, and it would be the certified internal auditor. These are similar qualifications of other accountants, but they passed a very specific examination to become a CIA. So this is just an extra feather in their cap, and they have proven their mastery in this particular area. Other financial areas where accountants provide their services are to government and nonprofits, government units at the municipal level, federal level, and the non-for-profit entities. These are colleges, universities, hospitals, voluntary health and welfare organizations. All require the same types of accounting functions to be performed as other accounting entities. However, there are some additional caveats to how their reporting occurs, and there are some other restrictions on them. Government and non-for-profit accounting is actually a very specialized type of accounting, and there are courses that deal directly with them. Professional services that accountants provide, of course, include income tax accounting, the United States Internal Revenue Code, and all the regulations coupled with state and local income taxes specify that there are particular rules and procedures that should be followed to determine an entity's tax liability. Some of these states have rules that are counteractive or different than that of the Internal Revenue Service. For example, the IRS disallows the expenses attached to the income from the sale of cannabis, whereas the state of Colorado does allow those expenses. It's important to have, as an entity, a tax practitioner who has a specialty in the taxation of your type of company and your industry. Accountants have to use their judgment and their expertise to design transactions so that an entity's overall income tax liability is minimized. This is not financial shenanigans. This is providing the adequate information and the judgment based off tax law and code on how a company needs to engage in those economic events. The accountants can also provide and prepare the tax returns, and they represent their clients whose returns might be reviewed or challenged by the taxing authorities. Accounting is actually a really interesting historical business transaction in that it goes back to 3000 BC, where we have evidence that the Mesopotamians recorded their tax receipts on clay tablets. Just stop and think about how far back that was. This is how important the economic transactions, the transfer of asset for resources or resources for assets, has been in the lifetime of the human development. Then around 1494, Luca Pacioli, he's a Franciscan monk, and he is a mathematics professor. He published what's called the Methods of Venice system. This is the first known text that actually described a comprehensive double entry bookkeeping system. What we use today in our modern bookkeeping systems have evolved directly from Pacioli's system. In the mid-19th century, there were a lot of absentee owners and investors that trusted managers with the operations of their companies. These owners and investors required reports from their managers showing the company's financial positions and the results of their operations. This makes absolute sense, right? This created the necessity for the independent audit function to add credence to these reports. When somebody else is operating and taking care of your business, your asset is using your resources, it's important that you can trust that the information you are receiving is transparent and accurate. This brought about the need for us to have auditing as a normal part of business. In the 1900s, the first professional accounting organization, the American Institute of Accountants, who is the predecessor of the American Institute of Certified Public Accountants, who are in place today, was established. The role of this organization was as a standard-setting body for the accounting profession, and this became evident with ferocity with the 1929 stock market crash. You will notice when we stop and we look back, there has been a lot of law and legislation that occurred following some type of significant financial fallout, some type of significant financial scandals. We are learning as a profession, and we are engaging in additional regulation and standard setting and requirements. As business evolves, what do we need to do to ensure that things remain copacetic and on the up and up? Part of the AIA was that they worked together to really establish the basic certification laws. They standardized audit procedures, and they brought some of the other attributes of the profession to light and said, this is who we are. This is what we are going to be. Between 1932 and 1934, the AIA and the New York Stock Exchange came to agree upon 5 broad principles of accounting, which is the first formal standard-setting activity. Accounting, financial reporting, and auditing weaknesses related to the 1929 stock market crash absolutely created a necessity for this to happen. The Securities Act of 1933 and the Securities and Exchange Act of 1934, both responsive to the 1929 stock market crash, gave the Securities and Exchange Commission, also known as the SEC, the authority to establish the accounting principles for companies whose securities had to be registered with the SEC. This is in response to restore investor confidence and to set forth accounting disclosure requirements for the stocks and bonds markets. The rules and regulations that apply to securities offered for sale in interstate commerce fall underneath the Securities and Exchange Commission. And while the SEC has the authority to establish the principles, the standard setting process has been delegated to other organizations over the years. The Committee on Accounting Procedures Accounting Research Bulletin dealt with specific accounting and reporting problems, but it didn't provide us with a conceptual framework for accounting which intensified currently existing controversies at the time. The Financial Accounting Foundation in 1973 was created and established the Financial Accounting Standards Board, also known as FASB. They are still in place today. They're the authoritative standard-setting body within the accounting profession. FASB has issued 168 statements of financial accounting standards that have established the standards of accounting and reporting of specific and particular issues, as well as broad general guidance. The accounting research bulletins dealt with specific accounting and reporting problems, but they still didn't provide that specific framework. The Sarbanes-Oxley Act of 2002 was created by a 5-member Public Company Accounting Oversight Board. The PCOB has the authority to set and enforce auditing, attestation, quality control, and ethics standards for public companies. Effective July 2009, all FASB's prior standards were superseded by the FASB Accounting Standards Codification, which reorganized a whole bunch of different pieces of GAAP into a really accessible and researchable format. FASB codification now represents the single source of U.S. GAAP. Changes to the codification are communicated through accounting standards updates, which are also called ASUs. And regardless of the form in which the guidance may have been issued prior to the release of the codification is our end all be all at this time. Although such updates do amend FASB, FASB does not consider ASUs as authoritative in their own right as the original codification. There have been 100 ASUs that have been issued through April of 2015. So standards for other types of accounting outside of public. There are multiple boards that actually come in and deal with this. For managerial and cost accounting, there is a cost accounting standards board that deals with government contracts. Remember when I said that things with governments and nonprofit organizations can be a little trickier? This is where we're coming into effect. The Audit Standards Board is part of the American Institute of Certified Public Accountants. They issue auditing standards and procedures to audit privately held companies. The Government Accounting Standards Board, GASB, establishes the guidelines for state and local government entities, public colleges and universities. The GASB operates with the authority of the Financial Accounting Foundation, which is also the parent organization of the Financial Accounting Standards Board, or FASB. With the advancement of a global marketplace, there became a need for comparability between financial statements that are prepared in different countries according to different standards that have developed. All the different countries used to have their own individual standards. In came the International Accounting Standards Board, the IASB, and their goal is to develop a single set of high-quality, understandable, enforceable, and globally accepted financial reporting standards based upon clearly articulated principles. The IASB is not the original organization. There was a predecessor. And they have issued 41 international accounting standards, IAS, and 15 international financial reporting standards, that is the IFRS, as of April 2015. Much of this was accomplished just before 2015 and continues to be in evolution as we go forward. There are many major nations that are now functioning in line with the IASB and their standards. But there has not been a convergence between the IASB and their standards or and FASB and GAAP. Although there is a commitment to convergence, there are some huge areas in which the US GAAP and IASB don't necessarily agree on. There are many companies that are, or many countries that are now adopting IASB, especially in the European areas. We'll continue to see this as something that evolves as business evolves and as we come into yet another generation of business. Professional accounting organizations, so the AICPA, the Institute for Certified Management Accountants, all of these different types of certification and professional accounting organizations require that their members conform to what's called a code of professional conduct. And if they do not comply with this and they do not conform with it, they can be subject to disciplinary action. The AICPA's Code of Professional Conduct identifies 4 key elements of ethical behavior. Integrity, being honest and forthright in dealings and communications with others. Objectivity, being impartial and free from conflicts of interest. What might be most important, independence, which is related to the objectivity, especially important for auditors, to be independent, not only in fact, but also in appearance. And then, of course, competence, actually having the knowledge and the professional skills to adequately perform the work that's assigned. These 4 elements are essential characteristics of the accounting professionals, which enable them to serve the best interests of employers, clients, and the public at large. In the mid-1970s, the Financial Accounting Standards Board began creating the Statements of Financial Accounting Concepts, or the SFACs, in an effort to define the underlying concepts of accounting principles and financial reporting practices. FASB issued 8 SFACs through April of 2015, the first 6 of which were issued between 1978 in 1985. These statements represent a great deal of effort by FASB, and progress is being made on this project, but it does not come easily. Change is not easy. In concert with their efforts to converge the U.S. and international accounting standards, FASB and IASB have undergone and undertaken a project to improve and converge their respective conceptual frameworks. This is also a continuing, ongoing project, and it's not going to come easy either. But it is something that hopefully we will see in the future. So to really set the stage more completely for your study of financial accounting, it's appropriate to have an overview of the foundational building blocks of financial reporting as expressed in Concept Statement number 8, Chapter 1, the objective of general purpose financial reporting. To gain a comprehensive understanding of the author's summary provided here, you may want to download the actual full text of Concept Statement number 8 from FASB's website. Financial reporting is done for individual firms or entities rather than for industries or the economy as a whole. It is aimed primarily at the needs of external users of accounting information who would not otherwise have access to the firm's records. Financial accounting is historical, scorekeeping. It is not future-oriented. Financial accounting information is developed and used at a cost, and the benefits of the user of accounting information should exceed the cost of providing it. A primary Objective of financial reporting is to provide timely information about a firm's earnings and cash flow. Financial reporting includes detailed notes and other disclosures. Accrual accounting involves accounting for the effects of an economic entity or transaction on an entity when the activity has occurred, rather than when the cash receipt or payment takes place. Financial accounting does not attempt to directly measure the value of a firm, although it can be used to facilitate the efforts of those attempting to achieve such an objective. Financial accounting standards are still evolving. With each new update to the FASB codification, accounting procedures are modified to mirror new developments in the business world, as well as current views and theories of financial reporting. Primarily, this text is divided into two parts. Chapters 2 through 11, which are the first part of the book, are devoted to financial accounting topics. Chapters 12 through 16 provide an in-depth look at managerial accounting.